Canada just entered a recession. But if you're expecting mortgage rates to collapse, home prices to crash, or the Bank of Canada to come riding in and save the day, you may be disappointed because this recession looks very different from the ones that Canadians are used to. And if you own a home, are renewing a mortgage, or are thinking about buying real estate, what happens next can impact your finances for years. In fact, some economists believe this may be one of the most confusing economic environments Canada has faced in decades. Because at the exact same time that Canada's economy is slowing down, inflation hasn't completely disappeared. Housing is weakening. Millions of Canadians are facing mortgage renewals at significantly higher rates. And the Bank of Canada is stuck trying to solve multiple problems pulling in opposite directions. You're not going to want to miss this because we're about to break down, are we actually in a recession? Why housing is at the center of the story, what happens next to mortgage rates, what happens to home prices, and most importantly, what homeowners and buyers are doing right now. So by the end of this video, you'll understand exactly what's happening in Canada's economy and why the headlines may not be telling the full story. So let's start with the obvious question. Is Canada actually in a recession? Technically, yes. A recession is generally defined as 2 consecutive quarters of negative economic growth. And according to Statistics Canada, Canada's economy contracted in both the fourth quarter of 2025 and the first quarter of 2026. That officially meets the technical definition of a recession. Now, here's something important. A recession is actually a backwards-looking measurement. It's telling us what already happened. It's not necessarily telling us what's going to happen next. In fact, some early estimates suggest that the economy may have actually grown slightly in the following quarter. So when you hear the word recession, don't think everything is about to collapse. Instead, think the economy has been slowing and now we need to understand what that means going forward. Because the bigger question isn't whether we're technically in a recession. The bigger question is how this recession affects homeowners, buyers, and mortgage holders. Many Canadians didn't need Statistics Canada to tell them we're in a recession. Because for a lot of people, it already feels like we've been in one for years. Think about what's happened. Mortgage payments have increased. Rent has increased. Groceries have increased. Insurance costs have increased. Property taxes have increased. Utilities have increased. And yet many Canadians don't feel like their incomes have kept pace. So while economists debate whether a 0.1% decline in GDP officially qualifies as a recession, many families are asking a completely different question. Why does everything feel more expensive than it used to? And that's where I think the real story begins, because after researching this topic, what became clear to me is that this recession itself isn't actually the biggest story. What's causing it is. And once you understand what's happening beneath the surface, you'll understand why this recession may affect home prices, mortgage rates, and your finances very differently than previous downturns. Because the warning signs were already there long before the recession became official. One of the biggest warning signs has been business investment. Now, I know that doesn't sound very exciting, but stay with me because this matters more than most people realize. Businesses vote with money. So when business owners are optimistic, they invest, they hire employees, they expand operations, they buy equipment, they open new locations, they take risks. But when businesses become uncertain about the future, they do the exact opposite. They pull back, and that's exactly what we've been seeing. Business investment has been declining for multiple quarters. That tells us that businesses are becoming more cautious, and when businesses become more cautious, hiring slows, expansion slows, economic growth slows, and we're starting to see signs of a slower labor market. Now, this is not 2008. We're not seeing mass unemployment, but we are seeing signs that employers are becoming more selective. Hiring is becoming more difficult. Job seekers are taking longer to find work, and businesses are becoming more cautious about adding staff. And here's why this matters so much for homeowners, because job security often matters more than interest rates. Think about it. If someone offered you a mortgage rate that's 0.5% lower, or guaranteed your job for the next 5 years, most people would choose the job security because your ability to make your mortgage payment doesn't start with interest rates. It starts with income. And as confidence starts to weaken, people naturally become more cautious, which brings us to another problem. Many Canadians are spending more while saving less. Saving rates have been falling. Debt servicing costs have been rising. Mortgage payments are higher. Interest costs are higher. And more income is being directed towards debt rather than building wealth. Now, that alone would be concerning. But when you combine that with what's happening in housing, things start to make a lot more sense. And this is where things become especially important for homeowners, because many people think housing simply reacts to the economy. The economy weakens, then housing weakens. The economy strengthens, then housing strengthens. But in Canada, housing doesn't just respond to the economy. Housing helps drive the economy. Think about all the industries connected to the single home purchase. Realtors, mortgage brokers, lawyers, appraisers, home inspectors, movers, furniture stores, renovation companies, tradespeople, banks, municipal governments collecting taxes and fees. A single transaction creates economic activity across dozens of industries. Now multiply that by hundreds of thousands of transactions every year. That's why housing matters so much. And that's why the recent slowdown matters so much. We're seeing weaker sales, weaker construction activity, we're seeing fewer housing starts in certain markets, and we're seeing lower resale activity. And in several major markets, we're seeing home prices under pressure. But here's the part that most people miss. Housing isn't only important because of home prices. Housing is important because Canadian households are heavily exposed to it. Roughly 3/4 of household debt in Canada is tied to mortgages. Think about that. 3 out of every $4 of household debt is connected to housing. That means when housing slows down, the effects spread through the entire economy. And that's exactly what's happening right now. Because the next challenge isn't just housing, it's something that millions of Canadians are about to experience personally: the mortgage renewal wall. And what happens next may surprise a lot of people. If you're new to my channel, I'm Evangeline, mortgage broker and partner at All Trust Mortgage Solutions here in Greater Vancouver. And I create weekly videos on mortgages, real estate, interest rates, and the Canadian housing market to help Canadians make smarter financial decisions. So if you're finding this video helpful so far, take a second to hit that like and subscribe button so you can see more of my content. Now let's talk about what may be one of the biggest financial challenges facing Canadian households over the next couple of years. Millions of Canadians took advantage of historically low rates during 2020, 2021, and early 2022. And according to several estimates, there are more than 1 million Canadian mortgages renewing this year alone. Many of those borrowers originally secured rates between 1.5% and 2.5%. And today they're facing rates that are significantly higher. And for some households, that could mean hundreds of dollars more every month. For others, it could mean even more. So now here's why this matters so much beyond the homeowner renewing their mortgage. Because people don't just stop paying their mortgage first, they stop spending elsewhere. When mortgage payments rise, families often cut back on restaurants, travel, entertainment, renovations, vehicles, discretionary purchases, and millions of households do that at the same time. Economic growth slows. This is one of the reasons why housing and the broader economy are so interconnected. And it's also why many economists believe that the mortgage renewal cycle will continue putting pressure on Canadian economy over the next couple of years. But if the economy is slowing, why isn't the Bank of Canada simply just cutting rates aggressively to stimulate growth? Because what I'm about to show you explains why mortgage rates haven't fallen, why prices haven't crashed, and why this recession looks completely different than what most Canadians expected. Now we get to what I believe is the most important part of this entire story. Because if Canada is officially in a recession, why haven't mortgage rates fallen? Why haven't home prices crashed? And why are Canada's biggest banks still making record profits? The answer explains almost everything that's happening in today's economy. Because if you've been wondering why the Bank of Canada isn't simply cutting rates, or why economists seem so divided about where rates are headed, this is why. Normally, recessions are fairly straightforward. The economy slows, businesses struggle, consumers spend less, and the Bank of Canada cuts interest rates. And those lower rates help stimulate borrowing, spending, housing activity, and economic growth. That's the normal playbook. But this time it's different. Because while Canada's economy is slowing, inflation hasn't completely disappeared. Oil prices remain elevated. Global conflicts continue creating uncertainty. And some of those inflationary pressures are still working their way through the economy. So the Bank of Canada is stuck. If they cut rates too aggressively, they risk reigniting inflation. But if they keep rates higher for longer, they risk putting even more pressure on households and businesses already struggling with higher borrowing costs. In other words, they're trying to solve two different problems at the same time. And those problems require opposite solutions. This is why you probably noticed economists disagreeing more than usual. And some believe recession pressures will eventually force rate cuts. Others believe inflation risk will keep rates elevated longer than most people expect. And honestly, both sides here are valid, which is why the Bank of Canada has become increasingly cautious. They're just trying to avoid making a mistake in either direction. What's interesting is that this recession isn't behaving the way recessions normally do. Historically, during a recession, home prices fall significantly. The Bank of Canada cuts rates. Banks are under pressure. But right now, home prices have softened, but we haven't seen a nationwide housing crash. The Bank of Canada has held rates steady, and Canada's largest banks are still reporting very strong profits. That's why so many economists are describing this as a very unusual recession. And it's also why trying to compare today's market to past recessions can be misleading, because some of the traditional recession playbooks simply aren't working the way people expect. And that uncertainty leads directly into the question everyone wants answered. What happens to mortgage rates now? Now, this is probably the question I get asked more than any other. Where are rates going? And the honest answer is nobody knows with certainty. But here are the few things that we do know. Firstly, many Canadians assume recession automatically means lower mortgage payments. But that's not necessarily true, especially for fixed rates. And here's why. Variable mortgage rates are primarily influenced by the Bank of Canada's overnight rate. So if the Bank of Canada cuts rates, variable borrowers usually benefit. But fixed mortgage rates work differently. Fixed rates are heavily influenced by bond yields, and bond yields are influenced by much more than just the economy. They're influenced by inflation expectations, government borrowing, investor confidence, global events, oil prices, financial market conditions, and that's why sometimes you can see fixed mortgage rates stay elevated even during a slow economy. And that's exactly what many economists are concerned about right now. This is also why some of the advice that worked a year ago may not work today. Many borrowers expected multiple Bank of Canada rate cuts in 2026, and while that seemed likely at one point, inflation has proven much more stubborn than expected. Energy prices remain elevated, oil prices remain elevated, and as long as inflation remains a concern, the Bank of Canada's ability to cut rates becomes more limited. That's one of the reasons why fixed mortgage rates have remained higher than many people expected. It's one of the reasons that many economists now believe that rates could remain higher for longer than borrowers originally anticipated. In fact, some forecasts suggest that fixed rates may remain relatively sticky throughout the rest of this year, which means homeowners waiting for mortgage rates to return to 2% or 3% may be waiting a very long time. Now, that's not meant to scare anyone. It's simply about adjusting expectations. The reality is that today's rates may be closer to normal than the ultra-low rates Canadians became accustomed to during the pandemic. And if that's true, then the conversation shifts from when will rates fall to how do I make smarter decisions in today's environment? And this brings us to home prices, because what happens next in the housing market may surprise a lot of people. Whenever recession headlines appear, many people immediately assume home prices are about to collapse. But housing markets are rarely that simple. Yes, there are legitimate reasons prices are under pressure. Affordability remains a challenge. Consumer confidence has weakened. Some buyers are sitting on the sidelines. Inventory has increased in several markets, and higher borrowing costs have reduced purchasing power. Those are all real headwinds. But there's another side to the story, and it's one that most people overlook: supply. Because while demand has weakened in some markets, construction activity has weakened too. Developers are delaying projects, some projects are being canceled, and housing starts have slowed. And fewer homes being built today means fewer homes available tomorrow. So we have two forces competing against each other: weaker demand and weaker supply. And one thing I want to be very careful with is about using the word crash. A crash is usually 20 to 30% or larger price declines. And that's not what we're seeing nationally today. What we're seeing today is that the market has softened. Prices are under pressure, sales activity is slower, and buyers are more cautious. But that's very different from a full-scale housing crash. And that's an important distinction because many Canadians are still making decisions based on headlines from 2022 and 2023. But today's market is much more of a stalemate. Buyers are waiting, sellers are waiting, and affordability is acting as a brake on both sides. That's one of the many reasons that many economists are forecasting corrections rather than crashes. Some major institutions expect further weakness in markets like Ontario and BC, and others believe prices may simply move sideways while affordability improves. The truth is that real estate is local. What's happening in downtown Toronto may be very different from what's happening in Vancouver. What's happening in Vancouver may be different from what's happening in Calgary. But one thing appears clear: this is not a market being driven by excitement and bidding wars. It's a market being driven by affordability, confidence, and financing. And that's why the next concept is so important, because I don't think that the biggest story is a recession. I think the biggest story is pressure. Pressure everywhere. After reviewing all the data, I think one word describes Canada's economy better than a recession: compression. Because right now, everyone seems to be getting squeezed. Households are being squeezed by higher mortgage payments, higher rents, higher insurance costs, higher grocery bills, higher taxes, and businesses are being squeezed by weak demand, economic uncertainty, rising costs, and the housing market is being squeezed by affordability challenges, higher financing costs, weaker confidence, and governments, they're being squeezed by higher borrowing costs, growing spending obligations, and even the Bank of Canada is being squeezed, trying to balance inflation on one side and recession risk on the other. And this is why so many Canadians feel stuck. The economy isn't collapsing, but it isn't thriving either. It's grinding, and in some ways, that slow grind can be more frustrating than a sharp recession, because a sharp recession often forces a response, and a slow grind can drag on for years, which is why Canadians need to focus less on predicting the Bank of Canada rate announcements and more controlling the things that can actually control. Which brings us to the most important part of this video: what should homeowners and buyers actually do? Let's finish with what matters most: action. Because understanding the economy is helpful, but making better decisions is what actually changes outcomes. So for homeowners, the first step is understanding your mortgage before your lender's renewal offer arrives. Know your renewal date. Understand what your future payment could look like. Know what options you actually have. If you're renewing in the next 12 months, Don't wait until your lender sends you a renewal offer. One of the most surprising realities in Canada is that many homeowners simply sign the renewal without negotiating or exploring alternatives. Yet your mortgage renewal may be one of the biggest financial decisions that you're going to make over the next few years. So shop around, compare options, understand the penalties, understand your refinancing options, understand your amortization options, because the difference between an average mortgage strategy and a great mortgage strategy can be thousands or even tens of thousands of dollars. The homeowners who navigate this period best are usually the ones who start planning early, not the ones reacting at the last minute. Because the people who struggle the most at renewal are usually the ones who get surprised. For buyers, stop trying to perfectly time interest rates. Nobody consistently gets that right. Instead, focus on your affordability, focus on your income, focus on your long-term plans. Buy when you are financially ready, not when you think you perfectly predicted the market. And as for everyone, build flexibility into your finances, reduce unnecessary debt, build savings where possible, avoid making emotional decisions based on scary headlines. And remember, every recession creates both risks and opportunities. The people who navigate these periods best aren't necessarily the smartest. They're usually the most prepared. Is Canada in a recession? Technically, yes. But I think the bigger story is that Canada's economy is being squeezed from multiple directions at the same time. Housing, mortgage renewals, inflation, affordability, slower growth, and a Bank of Canada trying to navigate one of the most challenging economic environments we've seen in years. The good news? Well, most Canadians don't need to predict exactly what happens next. They simply need to understand the environment that they're operating in. Because when you understand the environment, you make better decisions, and better decisions compound over time. Do you guys think that Canada is heading for a deeper recession, or do you think this is simply a temporary slowdown? Let's continue the conversation in the comments. And if you found this video helpful, make sure you hit that like button, subscribe, and I'll see you in the next video.